Welcome back. Well, it seems like almost every day these days, we're talking about the Federal Reserve, inflation, a weak jobs market. So I thought it might be helpful to go back to the basics. How does the Fed fight inflation? Well, the Federal Reserve, this is the Chicago Fed, our two goals of price stability and maximum sustainable employment are known collectively as a dual mandate, and that is the structure in which the Fed operates. They have to control inflation, that's price stability, but at the same time, create an environment that's conducive for jobs. Well, this is where we are now. The white line is a CPI, Consumer Price Index, a very popular measure of inflation on a year-over-year basis. And we know the CPI, the most recent level, was reported just a little bit above 3%. The yellow line is the Fed target. Now, this target was established in the past decade or so. However, it's understood over time historically the Fed wants the inflation rate to be around 2%. The black histogram or area chart in the background, that's interest rates. Interest rates right now at the 5.5% level. The Federal Reserve raises interest rates to slow down the economy, makes it a little bit more expensive to borrow money, all that kind of stuff. And that brings down inflation. So when that black area chart, interest rates goes up, inflation goes down. However, the red line represents jobs, non-farm payrolls on a year-over-year basis as well. And what happens is when the Federal Reserve raises interest rates, hopefully it slows inflation, but it also slows jobs. It also slows the economy. So the Federal Reserve has this dual mandate to bring the white line down without hurting the red line too much. This is where we are now on a year-over-year basis. Non-farm payrolls, that's around a 2% increase. Not too good. At the same period of time, inflation is going to the upside. Ideally, we'd want to see the red line go up and the white line go down. We have the opposite situation. Let's take a look historically to see what the Federal Reserve has done in the past. This is the period between 1982 and 1993. Now, we had a period of very high inflation back in the 1980s. The white line, we can see CPI, that was around 5%. Non-farm payrolls also chugging along at 5% on a year-over-year basis with our 2% yellow target, Federal Reserve target. And so the Federal Reserve raised interest rates. Well, that certainly did slow inflation and as well slowed the jobs market down. By the way, remember the stock market crash occurred in 1987. Important to note that, that was considered to be a hard landing. Hard landing is when the Federal Reserve raises rates too aggressively and it ends up slowing the economy too much. Well, then the Federal Reserve cut interest rates. See, the black area chart went down, and that led to a better job market where the red line went up. And the better job market led to an improvement in economics, and that's why inflation rose. See, over time, inflation, it's good if it's produced through productivity, not through, let's say, quantitative easing and a lot of excess money being put into the system. As we exit the 1980s into the 1990s, the Federal Reserve cut interest rates drastically, and then we see jobs exploded while inflation remained actually very tame. The early 90s, that looked like a really nice period of time. And then we know obviously this led to the very strong tech economy in the late 90s. Well, fast forward 1997 through 2003, we can see the Federal Reserve interest rates at 4.5%. Imagine that 4.5% still with a rather strong jobs market. And then we see inflation really started to rise, and the Federal Reserve raised rates to around 6.25, I believe, 6.25 or 6.5% at the top in 2000. And then the jobs market really fell apart. Now, here's something interesting, and it doesn't require, any kind of, special math, but just notice the difference, the spread between the red line and the white line. Notice what happens. The jobs market really fell apart in late 2000, early 2001. Inflation did slow, but there we saw the emergence of this gap where the red line went down first and then the white line followed. We don't want to see that kind of gap where the jobs fall faster than inflation does. It means that there's less jobs out there, but things are still quite expensive. We want to see the opposite. We want to see the red line go up while inflation stays, kind of stagnant, where we're making more money, but things are still pretty cheap. Well, we had that in 2000, the early 2000s, 2003, 2004. Federal Reserve brought us down to 1% on the Fed funds rates. And in 2004 through 2008, we saw a rather strong economy. We know the housing market in 2007 was quite strong. Take a look at how the Federal Reserve raised rates from 1% to 5%, but it did so between 2004 and 2006. It took the Federal Reserve 2 years to raise interest rates from 1 to 5. If you think about how fast the Federal Reserve has raised rates more recently, they've accomplished the same interest rate hike in half the amount of time, which leads us to the question, are we do we have a hard landing in our future if they raise rates too fast? Well, then we see 2006, 2007 when very strong, very high interest rates. Inflation was chugging along. Inflation, even 2006, really starts to waver. And take a look at this gap, the divergence between jobs and inflation. That's not what we want to see. Before the 2008 financial crisis, we already saw jobs were really falling apart in early '08. Inflation actually was still rising. But the Federal Reserve says, no, take a look at the jobs market. That's not good. We got to cut interest rates, which they did. Unfortunately, it was too late. And the 2008 financial crisis ensued, and we know obviously what happened after the fact. Now, fast forward 2016 through 2020, a rather stagnant jobs market. The red line is chugging around 1.5% on a year over year basis. I would not consider this to be a great economic condition. Inflation starts to rise. Federal Reserve raises interest rates. Again, 2016 through 2019, the Federal Reserve raised rates, but only gradually from 0.5% up to 2.5%. Very gradual increase in interest rates. So we see the Federal Reserve topped off at 2.5%. And in late 2019, they actually cut rates because we can see a lackluster job market, inflation started to waver below the 2% target. And when inflation is below the 2% target, that's why the Federal Reserve says, okay, well, we saw it on a quarter over quarter basis. It's time to cut. They were not obviously able to foresee what would happen, early 2020 with the COVID crisis, but the Federal Reserve was already cutting rates at that time. And then we fast forward to present day, we have a 2% inflation target. But as a result of the COVID crisis and a lot of stimulus, the Federal Reserve cut rates drastically, very, very quickly, and flooded the economy with M2. That's liquid money, overnight deposits, things of that nature, the most liquid form of capital. And that caused the incredible amount of inflation we see now. We see the CPI was above 8% on a year over year basis, June of 22. And we always talk about this. Why is June of 22 important? That's the beginning of the inverted bond markets. That's where the short-term maturities start to pay a higher yield than the long-term maturities. It's still happening today. Well, the dreaded divergence where the jobs market in 22 fell apart faster, started to decline faster. We had a divergence here, a growing, widening divergence between the red line going down faster. Inflation has been falling, but this is the trouble now. We're now at a 2% non-farm payroll year over year growth, which we know historically we want the red line to be above this yellow line. We don't want the jobs market to be any weaker than it is now. This is really as low as we want to see it. The white line is rising though. This we know from last week we had personal consumption expenditure. Before that, the CPI. It's oil, also PPI. It's energy prices. Energy prices is a reason why this white line is skyrocketing to the upside. And that's not what we want to see, where the jobs market is weakening while inflation is starting to rise. Now, the Federal Reserve, they like to say we focus on core CPI, core inflation, which does not take into consideration energy. But energy is something we use every day. Food and energy, which are excluded from core CPI, core PPI, core PCE. Well, that's really the kind of inflation we see on a day to day basis. We eat every day, we put gas in the car every day. Other kinds of inflation like rent, we only encounter, less frequently at least. So we'd leave you this question. What should the Federal Reserve do now, given a rather weak jobs market and rising oil, rising energy prices, which is leading to resurgence in inflation? And second question, what do you think the jobs market's going to look like? The jobs number is going to look like on Friday, non-farm payroll. If this number is poor, if we see it on a year-over-year basis break below 2%, does that change the Fed stance? How does that affect their dual mandates? All very interesting questions. We'd love to hear what you think, and maybe we'll get some more answers this Friday with the non-farm payroll, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.